Hey everybody, this is Jose here. We are about to start in around 20 seconds. This would be a great time to do a sound check. If you hear my voice, please go ahead and type anything on the chat box. Anything would do. So I know you heard my voice. I know technology is good, sound is good, and we are ready to start. Hey everybody, this is Jose here. Very nice. Okay, so we just reached the top of the hour. I believe all is good from a technology standpoint. So we are going to start our session. Here we go. So let's begin. Hello everyone. Today it's October 13, 2019. My name is Jose Blasco. I will be your guide. Today we are gonna spend some time together. We're getting together today for sharpening purposes. So sharpening purposes means that we take advantage of when the market is closed to get together and talk about could be techniques on how to trade, could be clarifications on how it works, could be looking into trading methodologies or more details about options or forex or anything, right? That's what we do when we do sharpening sessions. So basically we sharpen our skills so we are ready for when it's weekdays and the market opens and we are then ready to trade. Okay, so that's the plan. Nice to see you, Dennis. So that's the plan. So before we start, we'll go over the disclaimer. As always, I'll do this very quickly. The following videos, clips, demonstrations are for educational and instructional purposes only. Traditive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through demonstration do not indicate in any way the results you may receive on using our products. Good, and this takes care of the introduction for our session. Okay, so I'm gonna close this introduction slide. We'll get here our beautiful trade station. And today, the plan for today, it's questions and answers, okay, Q&A. So I'd like to welcome any suggestion or question or doubts or any need that you may have for a trade review or anything like that, okay? And therefore, you know, today it's a very, very open session, which depending on the amount of questions that you will bring to me, we may spend a little more time together, a little less time together. So, you know, I'm happy to spend X amount of time, whatever is needed to get all your questions clarified, okay? And I will start with a series of very good questions that I have received in an email coming from one of you guys, and I would like to begin the session today looking at those questions, commenting on it, etc., etc. And on your end, you know, I always talk about teamwork. So what I would like you to do is, number one, if you have any question, for sure, share with me on the chat box, and I'll be able to take a look and give you answers. But if you don't have any question, but as we review questions from other traders, and you have any comment or you have a question that comes out of reviewing something you never thought before or something like that, so please go ahead and also interact, okay? And it doesn't even need to be a question. So let's say, for example, we are reviewing something that happened to you too. It'd be nice if you could comment on, you know, what happened, you know, how did you approach it, you know, if you did something right, you know, so what was it that you did that helped you? If you did something wrong, so what was it that, you know, you identified with this experience and, you know, it was a learning curve for you, etc., etc. Okay, so again, today is questions and answers. The classical way to approach it is that you give me questions, I give you answers, but it doesn't need to be like that. I would like to make the session a little more open, where you can also provide answers, you can also provide comments, and you know, that way we have a little bit more interaction, even though I'll be the one using the microphone, but please go ahead and feel free to type anytime with anything that comes to your mind as we go over all of this, okay? So here is the first question I would like to address, okay? And I just got a screenshot of an email I recently received, and here it says, I'm just gonna read it and then we'll go over it, okay? So it says, I was first, let me say a big thank you for teaching us the UFO methodology. Thank you very much. Please refer and close my first ever methodology trade log for Forex. Based on sharpening session to build C confidence and P psychology, which a lot of work for me to follow rule and let the trade works as per plan, stop loss or target. Okay, so big aha moment there, I believe, for the trader. going from a methodology with, I would say, less rules to a methodology where everything is pre-planned, everything is rule-based, and sending here the first collection of trades, out of the first month trading with the rules. Okay, so all the trades are done in SIM, but as I will be allocating capital as per my initial plan, I will be spending September month as well with SIM to build CMP, confidence and psychology, and develop a routine before going live on October. Okay, so I believe that the trader, which I will not mention the name since I was not specifically authorized, but the trader is looking to go live in October and was giving himself a couple of months, which is August and September, to practice, to develop the skill, to see the results, and that way learn how to manage the psychology, but also develop confidence, okay, which is something that cannot be taught, isn't it? Confidence only happens when you put the work, okay, and you put the practice in place, and you get those aha moments one after the other one, and there is a moment in time where you look at yourself in the mirror and you're like, okay, I know what I'm doing now, okay, and this is coming because of approaching it properly with some time and effort at whatever pace that is, okay? Please feel free to provide your view or summary or any trade setup which I could have done better. I recognize I have not followed rules on the start of August month, which is correct after mid, okay? So this is a very good comment as well, because very, very often the normal tendency for all of us is to find excuses for whenever you broke the rules. Here I like very much what the trader says, which is, okay, so you know what, I recognize that I did not follow the rules 100% at the beginning of the month, but I still log it so I can review it, and I certainly acknowledge that I didn't do well there. Okay, so that's the way to approach it, with a very, very confident, looking for the confidence, but at the same time a very humble approach to trading. Knowing that the market is bigger than us, and our job is to follow rules, right? And because that will be what puts us in a situation to increase our probabilities and be mechanical, producing consistent action that should lead to consistent results. Okay, and when breaking the rules, of course, we open the door for randomness, and then anything could happen depending on luck. And obviously that would not be the way to approach it, okay? We discussed this many, many times. But again, very nice to see that this is properly acknowledged here, okay? So look forward to your comments and view. It's possible to review in tomorrow's sharpening session. Well, it was not exactly the same time because the email was sent at a different time, but we are reviewing it today, okay? So October 19, P&L summary, okay? I want to zoom in a little bit here. Hopefully we can still read all this text, even if we zoom in. So first of all, we can see, looking at the summary of the P&L, that we got a net profit of 310. So August ended up as a profit. The amount of trades taken were 18, which I need to come back to this figure and make a comment. The profits made were 700. The losses taken were 390. That's why the net profit was 310. Okay, it's the difference between 700 and 390. Break-even trades was 1. The risk per trade was 50, and the average risk to reward was 2. Okay, so congratulations. Okay, ending up on this first month applying the methodology with a profit. Okay, now having said that, a couple of comments here is that the trader was planning to use August and September and begin trading live on October if everything was good during the month of October and September. So in the month of August, we got 18 trades, assuming that in the month of September, let's say we got another 18, that would be a total of 36 trades, okay? So again, we could talk about statistics and so on for a very, very long time, okay? Some of you listening to this may be experts in math, and you could spend hours and hours talking about how to properly run stats on a series of data. In any case, my approach to looking at data is always to keep it as simple as possible. But within simple, something to always keep in mind is that the amount of samples that we need to collect to be able to extract conclusions that actually have certain level of meaning, it's important. So in other words, for example, if we only used August, okay, and based on the results of August, the idea was to begin trading live in September, my comment to this approach would be that it's too soon. okay, and too soon because 18 samples, 18 trades in this case, even though, of course, if you are profitable after 18 trades, it means that, you know, probably there is something you're doing right. You know, I mean, could you be lucky 18 trades? Yes, but you know, normally, you know, you would have a weaker result, if you wish, if you didn't do something right. Okay, so this is looking good. But in any case, you know, studies of statistics show that any data series with less than 30 samples have, let's call it an incomplete meaning when it comes to extracting statistical conclusions. Okay, so it would be very, very healthy, and I know that was your plan, but I'm making it as a generic comment for everybody as well. It would be very, very healthy that instead of getting into the trades after 18 samples, you were to, as planned, spend another month, in this case September, to collect another set of samples, surpass 30. Now look at the stats, and if everything is showing that what you're doing is correct, then begin trading live. Okay, so again, in a perfect world, you would go for even more than 30, maybe 100, things like that. But again, minimum would be 30. Okay, less than 30 would not carry such an important meaning. Okay. In any case, again, 18 trades have meaning. It's just that, you know, in the world of statistics and therefore trading, you know, the unexpected could certainly occur, right? And you want to make sure that the unexpected is the least likely as possible to happen. And therefore, it's important to have a list of samples, the longer the better. Okay, so minimum 30. So this is to be kept in mind. Again, coming back to the results, again, one more time, congratulations, okay? That looks very good. I have also been looking into all the screenshots of the trades that you sent, and certainly the note, you know, a very, very structured approach on how to apply the methodology, which is exactly what I need for myself, or what I need for you guys when you're running the trades, because again, whatever that diverts from the process implies randomness, and therefore now you are depending on luck instead of depending on a method where you control the ingredients of the method, okay, and therefore the expected probability. Okay, so I'm just gonna read your notes here as well as the review comments for Jose, okay, because this is gonna be very, very helpful for everybody. So first, notes and learning. So active trading of 8 minutes is difficult to manage due to office timing. Okay, so during the sessions, okay, and let me bring two tools. Okay, so first I'm gonna bring the flow chart, okay, which is the document that we follow, where we follow the process on how we execute the trades. And together with this process, okay, it could be Forex, it could be futures, whatever it is. I'm just gonna load the Forex one for a second. We also follow this list of timeframes, okay, which define the type of trader that we want to be. Okay, so we may end up using the 60-minute time frame as a common time frame, or the 4-hour time frame as a common time frame, or we may end up using larger time frames, okay, larger time frames such as the daily, the weekly, or the monthly. Well, these common time frames that we decide to use in our trades set the type of trader that we end up being. Okay, 8-minute time frame, okay. If you're using the 8-minute time frame as an edge time frame, that means that you are planning trades out of 60-minute climates, okay? And that makes you an intraday trader, probably quite active in and out during the day. And therefore, here the comment is that it's difficult to manage due to office timing. In other words, if you are doing these very, very active trades, and let's say you have to trail your stop, you have to review the trade, things like that, you have to review the climate every 1 hour, because it's the 60-minute common time frame, right? To use the 8-minute edge time frame. So that may not be convenient enough if you happen to work in an office and you are trading in parallel with having another profession or other time commitments, okay? So therefore, it would be interesting for you, and of course this would take more time, But for you or anyone else, okay, it would be interesting in a situation like this where you find yourself in a position where there are times that where you didn't have the time to cancel a trade, or you didn't have the time to enter a trade, or you could not manage the trade just because of timing issues. It would be important maybe to consider running a different trading style where instead of looking at the 60-minute time frame as a common time frame, you look at the 4-hour time frame as the common time frame. And now instead of reviewing your trades every hour, now you are reviewing your trades every 4 hours. Okay, remember that here on the top of the flow chart, okay, just gonna zoom in. On the top of the flow chart, okay, it says restart each close on the common time frame. Okay, so if the common time frame is 4 hours, the methodology restarts every 4 hours. If the methodology is 60 minutes, everything restarts every 60 minutes. Okay, so that's something important to keep in mind. That being open to change your style based on whatever situation you have in life, out of other responsibilities. Maybe you have kids, maybe you have another job, things like that. Well, this is something that makes absolute sense. Okay, so keep in mind that when we are getting together, sometimes we do short-term trading, sometimes we do longer-term trading, and of course, in my mind, we're getting together for 1 hour, and I plan to execute as many trades as possible for you guys in that 1 hour. And there are sessions that are intraday, and therefore I try to be as active as I can. Well, this could be a trading style that is 100% compatible with you, or it could be a trading style that is too fast for you. Or maybe it works the days you join me for 1 hour, but then when you are doing it by yourself, it's too fast because of your personality or time commitments, right? So again, that would be the time for you to apply the same method, the same process, use the same flow chart, everything the same, but switch to a different set of time frames, because that would probably make your life easier. And it's important because it has a direct impact on your mindset. So if you were to execute your trades and you are stressed out because you are under pressure and it's because of time, you are more prone to make mistakes based on psychology, on emotional impacts on our psychology. So we need to be relaxed when we trade. And again, the time frames are key. Number 2, focus on one time frame. Okay, 240 for setup, 6:30 a.m. UK time, and review the open trades at 10 a.m., which is, exactly. So, if you were to use the 240-minute time frame, so everything happens, as I just said, every 4 hours, and everything is much more quieter, which I believe this is your point here. So keep stop loss at the 20 EMA, 240 minutes if it's close to the 9 EMA. So, I believe that what you're doing there is that you are adding one more rule in our, which could be absolutely fine, okay, but that would be something for you to test, okay? In our rule here where we are setting the stop, we are using the edge time frame to define the stop. Okay, this is our rule. But it seems that what you're doing is that, okay, if my stop is close to the 9 EMA, I will look for UFOs around the 20 EMA and I'll place my stop somewhere there. So you are giving yourself a larger wiggle room, okay, and this could make sense. Okay, now my thought when I think of it, and I have not tested that myself, so you probably know the answer better than me, but my thought when thinking about this is that from the 9 EMA to the 20 EMA, there will be at times, especially when you have a clear climate, at times you should have a great distance between the 9 and the 20 EMA. And if that's the case, and your stop is all the way below the 20 EMA or above when you're shorting, there may be cases where the market changes climate before you get stopped out. Okay, so in other words, you may increase the probability of being stopped out by having the stop so far out. You would think that because the stop is far away, you may have less chances of being stopped out, but precisely because the stop is so far away, for price to get there, it means that you have a full change of climate, and therefore, if that was the case, you are actually very likely going to be stopped out. So I would say that maybe if you want to do something like that, I would suggest to experience what would happen if instead of using the 9 EMA, maybe you use something closer, like maybe the 12, the 10, something like that. Use a couple of EMAs that are closer to each other, if you want to make that a rule, just to give yourself a little bit more breathing room, but without having the market change climate on you, and then you get stopped out, and you were hoping not to be stopped out because the stop was so far away, but that's actually the issue, that you felt into hoping not to be stopped out instead of trading whatever climate you have, where if you're right on the climate, you make a profit, and if you're wrong, you get out for the minimum loss. Okay, so if the stop is too far, then the loss is not minimum, the loss would be greater than minimum. Okay, so this is something to consider. Okay, and I would say that based on common sense, what I just said should make sense. And but again, I'll be curious, and feel free to shoot an email to me that how did it go during the September. Okay. And if your methodology worked well and you're comfortable with it, and you have developed the C for confidence, it could be fine too. Is that making sense? Again, as I said at the beginning, I did not test your proposal here with the stop beyond the 20 EMA. Okay. Next question here: for level over level or level below level, use deep entry to reduce the risk, a safety target. It makes sense. It makes a lot of sense to me. Again, as long as your EMA rule is still in place, okay? Because let's say, for example, you have, let me try to draw it here on the screen. So let's say you have a UFO here, right? And then you have another UFO somewhere here, and they're kind of overlapping each other. Okay, and of course now if you're gonna treat the whole zone like it's one UFO, now the zone becomes quite wide, right? And on the top is your entry, on the bottom is your stop. Okay, but now the zone is quite wide. So you are saying, you know what, instead of entering right here on the top, I'm gonna enter somewhere in the middle. Okay, and therefore I reduce my risk. Okay, and I would say it's fine, but I would be very careful of the inner circle on the upper UFO going long, or the inner circle on the bottom UFO when going short, because those inner circles represent the area where we are expecting the greatest quantity of unfilled orders. So if, let's say, your entry was to be so deep, which is somewhere in the middle of the two UFOs down here, the problem is that basically you got plenty of the unfilled orders that should have worked, didn't work, and again, that may signify a change of climate. Remember, in a down climate, buy orders tend to be canceled. In an up climate, sell orders tend to be canceled. So in this sense, okay, entering too deep may be the recipe to enter when you actually got the evidence that things are not so good anymore, right? So my suggestion would be to enter as deep as possible, but respecting the inner circle. So I would say the deeper would be somewhere here, okay, in that particular case. And by the way, this is assuming that the EMA, okay, the 9 EMA from the other time frame is somewhere here. Okay, so you are entering in a place where the EMA is still overlapping the zone. If the EMA was to be above your entry and you enter below the EMA, again, you may be entering in a changing climate, and therefore it may hurt you afterwards, even though mathematically and in the world of theory, you are right, you have less risk, but then you end up hurt because you are not entering at the very right time. Okay, so that would be my initial comment for you. Okay, and ultimately, if your goal is really to reduce the risk, okay, so another thing you could do is to use the reactive time frame. Okay, use the reactive time frame. Again, this is gonna be more tedious, and you will need to watch it, and based on what you said, may not work for you because of the office timing, right? But let's say, for example, you plan trades on the 240-minute common time frame, and you were to identify your UFOs on the 21-minute time frame, okay, but you got multiple UFOs overlapping each other, and the zone is very wide, and you have all this risk. So then what you may want to do is wait for new UFOs to form on the 8-minute time frame and trade those reactive UFOs, which are going to be way tinier, and therefore they will have much less risk. Again, problem of reactive time frames, we discussed that in the past, is that you may miss the trade completely because price bounces and created a UFO in the wrong location because price bounced too fast, and then the UFO is too far out, and now you find yourself almost chasing price. Okay, but again, that would be those would be the options for you. Either enter inside but respect the inner circle and making sure the average is still in the right location. Okay, and optionally use the reactive timeframes. That would be the way to reduce risk in cases with overlapping UFOs. Okay. Okay, number 5 here, max trade setup 4 to manage the risk per day. Okay, good. So one of the ingredients of the methodology is to use a safety target, isn't it? So one of the things that you could do, or you could make as a rule, to me that would be my way to approach it. Okay, even though what you said is fine, 4. So let's say you are risking 1% per trade, and therefore you are giving yourself the opportunity to lose maximum 4% per day. Okay, so that would be your case, and that if you were to have a rule like that is fine, but just an extra suggestion here, okay, out of a personal preference, okay, which doesn't need to be like that for you, but to me it does make sense, which is that I will accept taking infinite amount of trades per day. I will not limit myself to 4, but I will only take new trades after I reached safety target in the prior trade. In other words, I keep adding trades to my account, but only when the prior trades have no risk anymore because I already reached safety target. Okay, so if I already got one trade running and I haven't reached the safety target yet, and another trade is ready to be taken, but I haven't reached safety target yet, then I would not take the trade. Okay, and that's it. Okay, that would be another possibility just for you to think about it in case that makes sense to you. Okay. What else do we have? Very good questions, by the way. This is great. This shows a huge amount of time and effort put in place for you to come up with all those examples, cases, aha moments, questions, notes. All of this is not coming out of the blue. This is coming because I'm sure that you're putting time either after your office time or before you go to the office, which says a lot about how serious you are about trading. Okay, so congratulations on that, and keep up the good work. More comments here. Observation from the last 18 days. So it says here that price reaches to reward to risk ratio 2, then either closes at break even or stop out. Okay. Okay. So sometimes, okay, and again this changes. Okay, especially if you are trading very low time frames. Okay, or you are trading at times. I mean, let me show you this, and you will understand. Okay, because this is what we have. So this is the S&P 500. Okay, that's an ETF. So let me load the S&P 500. Oh, sorry for that. SPY. Here we go. So this is the S&P 500, and when I look at the S&P 500, okay, and I load a chart, starting from here, for example. Okay. Oh, you know what? Let me do this. So if you look at what the market has done this year, okay, I'm just gonna go back to January 1st. So January 1st is right here. It will be January 2nd, of course. So if I measure what the market has done, okay, more or less we had a starting point here, more or less here. And if you measure it to the current price, okay, so from here to here, we are dealing with percent change. We are dealing with a market that went up by 18% since the beginning part of the year. Okay, so you would say, okay, that's not bad. The market did move nicely, and yeah, it's not bad. Okay, but if instead of looking for that period of time, you look at the market, and I'm looking at the S&P where your comments, I believe, are coming from trading Forex, okay? But really, we need to understand that in the end, it's the U.S. markets are driving everything worldwide, okay? So it's the biggest markets electronically traded in the world, and therefore the influence is massive. So notice that, if basically I put a line where the current price is and I move to the left, okay? So now we are in the territory making all-time high, okay? We are in the territory making, well, not really all-time highs. The all-time highs is just a little higher. But basically, if you look at October 1 year ago, okay, from October 1 year ago to now, if I was to measure the performance, okay, because if I measure from January, yeah, it's 18%. But if I measure from October last year to now, it's almost horizontal. We got 1.05%, as you can see. Okay, so in other words, the market didn't do much. Okay, didn't do much. Okay, and certainly if you look at this latest part on the chart, okay, starting, let's call it July, it went down, it went up, it went down, it went up, it went down, it went up, and it's just ranging, not doing much. So when this type of situation happens, this type of market behavior normally reflects in many other markets. And again, being the S&P, one of the most important markets in the world, this also spreads into Forex. And the outcome is exactly what you comment, that in many of your trades during the month of August, you had many cases where you had your entry, you had your stop, you had your safety target, you had your final target. Okay. Hey, Orlando, how are you? Very nice to see you, Orlando. And when you were planning for your final target was way farther away. And then, you got a nice bounce, reacting to your EMA, your UFOs, your climate, and everything that we do. You started seeing the market move your way, reach safety target, you got all happy. But then instead of going all the way to your final target, it did like 2-1 or so, and then turned against you and stopped you out at break even or something like that, and never went much further, as you can see. Okay. And so why is that happening? Well, again, this changes through time. If going to an extreme, if you have traded in 2008, okay, that's 11 years ago, when the markets were crashing, I'm telling you, you would have reached almost every single time your targets, because the markets were so volatile that was really fun. Okay, so markets change those conditions. Okay, and there will be times where you need to manage your own psychology when your trading plan is not being met all the time, because in one hand, it's very frustrating to see that, let's say you have a situation where 75% of your profitable trades don't reach your target, and you still end up with some profit because you trail your stop and things like that, but let's say 75% of those trades don't reach the final target. So what is the typical temptation you may have? Well, your typical temptation would be like, you know what, I'm just gonna go ahead and place a target, somewhere in the middle. Mathematically, I'll do a 2-1, I'll do a 3-1, that's it, done. And you know what? For a period of time, that may actually work better. But then the markets may change condition, and then now you are leaving a lot of money on the table. And if you were to realize that, then you would get frustrated, and then you would change the way you set targets again, just to see the market conditions change again, and then you would go back to, oh my God, I'm not reaching my target. So again, markets change. And that's why in the methodology, we got 3 components. Number 1, a final target, typically quite far, because our job is to maximize profit. Number 2, we got a safety target. The safety target has one purpose, which is to remove the risk of the trade quickly, so we are safe. And also that way you can add more trades, okay, in parallel without risking more. That's the purpose for the safety target, okay? And then we have rules for trade management, okay? So if you look at our flow chart, we got rules for trade management, where one of them is the UFO trailing exit, the other one is the too far too fast exit. So again, could you have more rules? Yes, we can do more things, okay? And if you have other rules in your plan, it's absolutely fine. But at the same time, what you should try to avoid is looking for the perfect methodology, because it does not exist. Okay, and even though it could be perfect at some particular time in the history of the markets, believe me, the markets will change, and something that was perfect at some time is not perfect later on. Okay, just to make my point, I'll give you a pretty extreme example. In 2008, going back to 2008, okay, trading Forex, you would be able to see the Great British Pound against the Japanese yen pair, okay, the GBP JPY. That currency pair used to move 450 pips every single day. It was not weird. It was normal. Sometimes it do 600 to 700 pips in one day. That was not normal, but 450 pips was normal. Okay, well, how much is the euro nowadays? Okay, so if I load the euro, or let's load the GBP JPY. Okay, if I load the GBP JPY and I look at, this currency pair was known as the beast. Okay, this is how fast it used to move. Well, if I load the average to range, this pair is currently moving 148 pips per day, as you can see here. 148 pips per day is like 3 times less compared to what this currency used to move. Okay, it's actually less than 3 times. Okay, in other words, things change in the marketplace. And if you are looking for, if you are always shooting for the perfect methodology, then it's a problem because it does not exist, and that keeps leading to frustration. Frustration keeps making you vulnerable to being impacted to emotions, because the moment you are frustrated, you are seeking revenge. Okay, and that may be unconscious. So we need to trade in a way that is peaceful. We need to trade in ways that are relaxed. Okay, and therefore, once you have your methodology and you practice it, as long as you are comfortable with it, you develop confidence, and you are profitable, then leave it like that and just trade your methodology. Okay, and there is nothing wrong to have a few tweaks throughout the years as you grow experience and you develop, some, you develop some aha moments, you develop some preferences. Maybe you realize, what, I don't want to use the safety target. I'm fine. I'll only trade one trade at a time. So, you may develop some preferences on how to trade. So then you want to go back, you want to test it, you want to make notes, you want to review your stats. And if all is good, then it's okay to change some rules in your methodology, but not like every 2 weeks, just because every 2 weeks you realize that, if I had put my target here, it would be better, because markets change. Okay, and what we don't have is a crystal ball. So the key is to keep working on a process that stack odds in your favor without looking for perfection. We are looking for balance, not for perfection. Okay, cool. So can we keep 3 targets? 1-to-1, 2-to-1, and then more than 3-to-1. Okay, can we do that? Well, I'm gonna say yes and no. Okay, so yes, you could certainly do that. Okay, and going back to my comment, if you were to trade a market where you notice that all the time you reach 2-to-1, okay, and that's why you want to do that. Okay, and only 25% of the times you reach the final target. So then if you were to take the decision just because of that, which based on what I said before, that would be an error, then I would suggest that you get rid of the last target. Okay, and you just take profits at 2-to-1, and that's it. Okay, I would suggest to do that. Okay, but again, that would be erroneous, because then you are setting target based on prior results, and the nature of the market changes and will change your results, but your results will not change if you have the target set fixed at 2-to-1. Okay, so I would not do that. Okay, I would not do that, even though you could. And the other reason why I would not do that is because if you take 50% as safety target, and then at 2-to-1 you take the other 25%, then when you reach the final target, you are only left with a fourth of the capital. And really, even if that target was to be so far away, which the further away the target is, the less likely it is that you will reach it, right? So even if the target was to be so far away, well, now you got 2 problems. You are very unlikely to reach it, or much less unlikely to reach it. And if you do, the price you get paid is not worth it, because the size you still have left on the trade is very small. Okay, so I would say it's not the best approach. Just to share a little personal experience here, when I started learning how to trade, and some of you may know this because I may have said it in other sessions, my background was engineering, so that was my prior profession before getting into trading. And of course, the mindset of an engineer is perfectionist by nature. We are looking always for the best way to do things, right? The optimal way to do things, I should say. So with that optimization mindset, I was looking for the best methodology in the world, and I remember using 3 targets. Okay, I remember using 3 targets, and exactly what I just said used to happen. Okay. Many times I would reach target 1, target 2, but very few times I would reach target 3, because my target 2 was in a good location that made sense for a target, but target 3 was a target placed so far out just in case. And yeah, the level of satisfaction you would get as a human when you will reach the final target was amazing. It's like, oh my God, this is an amazing move. This is the trade of the month, right? So it was such a great satisfaction. But then when it hit me was one day when I reviewed many of my trades, and I added all the results, and I started playing with what if scenarios, which is what if I didn't use target 3 and I only used target 1 and target 2. And when I did that, I would have made so much more money at the time, right? And that led me to stop using target 3. And again, why is that? Because my target 3 was in a position that was not reasonable anymore, or it was very unlikely. And second, when price would get there, my size was so small that even though the target was so far, it would not really help that much. Okay, and the two things together help me understand that the more targets you have, the more you scale out. Yeah, the prouder you are when you get to that final target, but the less money you made in the process and the longer you stay in the trade instead of shooting for another trade or run more trades in parallel. Okay, so again, we are not looking for perfection. We are looking for a balance. Okay, and by the way, if you were to tell me, look, I'm super busy in the office, I need to plan my trades very quick, I want to set my target at 2-to-1 mechanically because I've been looking at that and it's worked well for me, and I'll do 2-to-1s and that's it. You know what? Do that. That's it. Okay, but having target 1, target 2, target 3, target 4, it falls too much into perfection, and basically it doesn't really help. Okay. Next question. When the 9 EMA and the 20 EMA are close, would it be a good idea to keep the stop loss at the 20 EMA only observation zone becomes too wide? Well, it's kind of what we said before. Okay, and the only time the 20 EMA and the 9 EMA will be very close, it's either because you have a new climate that just begins, or because the climate has been quite unstable, and therefore that market is quite flat. Okay, so in the first case, I would not trade, and the auto climate with the thick dot and the thin dots are probably giving you the right indication, so that's it. But in the second case, where you are at the very, very beginning of a trade, a new climate, sorry, not a trade, at the very beginning of a climate where a market starts pushing hard in one direction, so it could certainly make sense, okay, that you go ahead and you place your stop below the 20 EMA if they are close enough to the 9 EMA, okay? But I would add one more thing, only if the 9 EMA and the 20 EMA are being enveloped by UFOs. So don't do it only because of the EMA, okay? Because the EMA being an important tool, as we know, because it may add orders in the market that are not in the market yet. The fact is that the probability of this happening is less than relying on on-field orders that are already in the market, right? So in that sense, you will want to make sure that not only you have the 9 EMA and the 20 EMA close, you also need to have UFOs that are enveloping both of those EMAs, not only one, okay, both. Next one, okay, and by the way, guys, for the ones of you that joined late, okay, today, as you can see, is a Q&A session. So if you have any questions, okay, make sure you type, because it seems that I'm getting close to the end of the list of questions I have, and then I'll be taking your questions, if any, okay, and if you don't have, it's fine, but if you have any question, again, begin typing, so when I'm done, I can have those questions already on the chat box, okay? Good, so next one, any rule to consider how wide the zone we can select? Sometimes the zone are too wide, especially for intraday 21-minute time frame. Okay, good. So again, we could certainly add more rules. Okay, we could certainly add more rules. You could say, okay, so I am planning trades with, let's say, for example, you are trading the 240-minute time frame for the common time frame. Oh, okay, I see. I just typed an extra letter. So let's say you are using the 240-minute time frame when trading the JBP, JPY for climate purposes, and let's say that therefore you are using the 21-minute time frame for the zones. So, like for example, when you look at all these collection of zones, okay, let's say those were enveloping the EMA, you would say, okay, so I need to merge all those zones and treat all those zones like it's one fat zone, okay, creating an entry all the way on the top and a stop all the way in the bottom, creating all these vertical distance, which may be way too much for risk, okay? So what is enough risk and what is not enough risk, okay? So, as a rule of thumb, you would want your zones to be the narrowest as possible. We have no control over how narrow or wide the zones will be. If you look at this zone, notice how this zone is quite weak. If you look at this zone, that zone is way thicker. Okay, we don't have control over that. Okay, we don't have control over that because the app reacts to the market data given and therefore plots the zones wherever the zone should be. There is nothing manual that you could control. I mean, the only thing is the calibration, isn't it? With the calibration setting, you end up impacting the width of those zones, and we did calibration videos that talk about that. I use 61.8, as you know, and that's it, But once you are given the zones you are given whatever calibration settings you use, that's what it is. So, you could approach this in two ways. Notice that if this was to be my entry here, okay, let's say that was to be my entry, okay, and this was to be my stop, okay, and therefore this is the vertical distance that represents my risk, and if I project this above, that represents the right location for the safety target, okay? So you may say, okay, that safety target is way too far away. You have heard me say that in the sessions at time where, there are times where I said, you know what, this trade is okay, but I'm going to pass on it because the safety target is so far out that then the safety target becomes a target and it loses the purpose of being a safety tool. The safety target has one purpose, you probably remember this, which is to remove the risk of the trade quickly. So not only you can have a greater peace of mind knowing you cannot lose anymore, but now on top of that, you can go ahead and take other trades in parallel and therefore potentially make more money without increasing the risk, because the first trade you took have no risk anymore because you already hit safety target. Okay, so you have heard me at times say that safety target is too far, so I'm going to pass. Every time I make those comments in the sessions, okay, I normally try to keep it very simple. And again, it's also a matter of experience where, visually speaking, when looking at the chart, okay, my eyes go left, okay, my eyes go left, and you look at what a 1 day of trading has been, okay, what a 1 day of trading has been, which in this case is from 11 to here 13, okay, and you look at how much price has moved from here to here, right? And basically, if I'm looking at this vertical distance as the daily move, okay, and I'm looking at this, it's kind of like half of the daily distance, okay? It means that I get to safety only if the market moves in my direction for half a day, okay? And again, I'm being very imprecise, but it's good enough. No need to be perfectionist here either, right? So it's like, for me to reach my safety target, I need at least half a daily move, right? And it's like, so I really need to be right here, okay? I would prefer to get into a trade where by being right 10 minutes, 30 minutes, 1 hour, I get to my safety target and now I have no risk. I would prefer that by far compared to I need to have the market move my way for half a day, 12 hours to remove the risk of the trade, okay? So basically what I do normally is it's kind of like look left, okay? And then out of identifying the beginning part of the day, I then vertically identify how much is the daily move, and then I quantify this against the distance for my safety target from entry. Okay, and visually speaking, I will want this to be small. Okay, and again, I do this in a way that is quite automatic. This is one of the few things I do in trading where I don't have a written rule for that, because it would make trading complicated. So I could go ahead and use ATR for that. For example, I could say, so the average true range in my common time frame is 82 pips. So maybe I want a third of that, okay, which is like 30 pips. So from 55 to 66 is 100. So 100 is way more than 30, so I'm not going to do it. So you could do something like that, and if you want to develop a rule based on the ATR, it would make a lot of sense. But again, when planning trades, I also look for speed of action and not spending too much time looking at the chart for too long, and therefore I just act visually. Throughout the years, I learned that was good enough. Okay, so you just want a small quantity of what a daily move would be to be enough to remove the risk of the trade. That way, just by being right for a few minutes or a few hours, you are out of the risk, and now whatever happens doesn't hurt you. And if it happens the way you think, then now you profit. Okay, so that would be the approach, and again, that would be the answer to your question. And the last one, for overnight 240-minute time frame trades, for overnight trades, do I need to take any care? Well, actually, we did a session where we were talking about how to deal with overnight trades, isn't it? Let me see if I can find this session, because there is a whole hour video talking about that. So let me I'm just loading it on my other computer screen. So I'll bring it into the main screen in just a second. Okay. So this is the sharpening playlist. So let me see, gamma hedge, long-term, sharpening, calibration, intraday. Okay, let me see, Q&A, futures, debits, trade, auto climate, psychology, weekend wrist. Here we go. Here, that's the one, weekend wrist. Okay, so you would want to come in here and sharpening weekend risk. This is a video that talks about taking care of trades where you expose yourself to gap risk, okay, overnight risk or gap risk. Okay, so how to deal with that, please go ahead and watch this video that we did in July 13. Okay, cool, very nice. By the way, since I'm using YouTube here, go ahead, my friends, and click on the thumbs up button if you are enjoying this video, and also if you're not subscribed to the channel, make sure you do subscribe to the channel and then click on the bell so you get the real-time notifications. Okay, so done with those questions. Very, very powerful questions. Again, I'm delighted when I see emails with questions like that, because it means that you guys are doing the right thing to become the type of trader you want to be. Okay, so congratulations for that, and way to go, my friends. Okay, so question here from Dennis on the chat box. Okay, so for the auto climate, how to make the confirmed dots larger than the default? Well, it is not possible, Dennis. It is not possible. The auto climate, has certain visuals that are preset, and the one thing that you could interact with is the inputs. So if I double click on auto climate, you can certainly act on the inputs, but when it comes to the style or even the colors, all of this is preset in a programmatic way, and therefore it doesn't matter what you change, it will not change the dots. So it's the way it is. Okay, so we may come up with a different version of auto climate at some point. We had cases of colorblind users that are having a little bit of a tough time. I guess that we'll come up with some sort of a easy to implement solution, but at the moment in time, it's the way it is. Okay. Remember as well, for auto climate, probably, to be honest, the best way to use auto climate is actually on the radar screen. Okay, I believe all of you probably seen that, but just in case, I just want to load auto climates in the radar screen. Okay, and when I load this, okay, notice how here very quickly you can see the confirmed climates against the non-confirmed climates. Okay, so how do you know the climate is not confirmed and therefore is a thin dot? You know it when the color is gray. So when the color is gray, it means unconfirmed climate. When the color is either sapphire blue or ruby red, okay, that's a confirmed climate. Of course, ruby means down climate, where sapphire means up climate. Okay, but when it's gray, like those three cases here, or here, natural gas and Japanese yen, for example. So when it's gray, it means it's not confirmed. Okay, so if you were to load the chart, then you will get a thin dot. Okay, for sure, it's nice to kind of double check the climate here on your chart as well, but you're gonna get the same thing. Okay, it's gonna be exactly the same thing. So really, you can rely on the radar screen as much as you rely on the chart itself. Okay, so this is your answer, Dennis. Good, very nice, everybody. So okay, what else? Everyone out there, questions, comments. It doesn't need to be questions. Okay, it could be comments. Maybe you have been trading the methodology. Maybe you have something to say. Oh, I noticed this, I noticed that, this happened to me the other day, whatever. It doesn't need to be specific questions, okay? But this would be the time to kind of share with the group, because today is the day to do that. And I'll be delighted to receive your questions or comments and go over it, okay? If it's all good, then we'll finish the session sooner than expected, which is okay. It'd be a little unexpected for me though, because I would expect that you guys may have questions or comments. But if you don't, actually you'll make me happy, because I will understand that it's because everything is going well, okay? And by the way, this is also an important comment to be made. Some of you may not feel comfortable typing the questions in the chat box. Maybe, let's say, you have gone through a few losses because you broke the rules or something happened, and maybe you simply don't feel comfortable texting it on the chat box because it's public, which obviously is something I would respect, okay? But don't have this stop you from sending us an email, okay? Just send an email if you need support, if you need help, and we'll assist you, okay? And if your question is quite complex and really we cannot answer with a few paragraphs because your question is very in-depth, okay? So no problem, I'll take care of those questions in the next get-together sharpening, okay? And I can give you answers using the microphone, using the screen, going over chart examples, and I will keep it anonymous, okay? But I will bring the support for you guys, okay? So speak up if you need our help, guys, okay? Don't ever be isolated, okay? Which is a classical mistake I've seen many people make, including myself when I started learning how to trade, because you develop such a passion for trading that you don't ask for it, and you keep practicing the same thing over and over again. You may be developing bad habits you didn't realize you have, okay? And so speak up sooner than later, either to share the good or to ask for support if, for whatever reason, things are not ideal in your trading at the moment, okay? So I said it many, many times, and some of you are definitely following this advice, but if you are not, make sure you understand there is no need to be shy here. I myself, one day in the past, was learning how to trade, and I am a person, meaning human, meaning I make mistakes too, okay? So make sure you understand that our approach is that we are fully understanding of that fact, okay? Cool, okay, so yeah, it seems that no one is adding anything else. So if that's the case, I believe that we're gonna have to call it a day. Yeah, so it seems that we're gonna have to call it a day. Okay, good. So guys, just to make sure that we're done, if you could type a quick goodbye, that would be nice. Not only because of receiving a goodbye from you, but also because I would understand that you are okay with concluding the session. So please go ahead and type a quick goodbye on the chat box, and I will be seeing you very, very soon. I will be seeing you very, very soon. Next week during the next week during the live trading sessions for short-term and long-term. So make sure that you join me at that time. Great. Okay, everybody, you guys take care. It's been a pleasure to be here. Same to you guys. If you're watching this recorded and you need support, make sure that you take care of that, okay? Okay, everyone, take care and see you soon. Bye-bye.